So we got a lot to talk about, and let's begin just with your view on the markets. We've been around record highs. Where do we go from here, do you think?
So the S&P has been a phenomenal index. The returns have been driven by a handful of companies that have been able to leverage growth at scale like we've never seen before. And for a minute, let's celebrate America. These are all American companies leveraging the American capital markets, and it's a wonderful thing. But the performance. If I came on your show in the beginning of 2023, and if you told me then that these stocks would have performed the way they have, I would have been skeptical, like most have been.
Sure.
So, can it continue? I don't know. It's a very powerful trend. I think there's a difference between what's happening with a handful of companies that make up a big portion of the S&P 500 and what's happening with the other 490 odd businesses. Mm-hmm. And with the powerful AI trend, it'll work until it doesn't work. There's been a lot of positive circularity when the hyperscalers say they're investing more money in AI and their stocks work. It's more money that can go to NVIDIA and drive this amazing trend. It'll last longer than we think it will. And I'm not going to make a call on that. Where we're going to spend our time focused is on the other 490 stocks and trying to find high quality businesses going through change, trading at reasonable values.
You still are, though, investing in those big names. I mean, you hold many of them, correct? Right? You boosted your stake in Alphabet recently. Is that right?
So our view is we should run a balanced portfolio. Mm-hmm. There's no way we're going to have 20 ideas that are better than all of the large cap names. And if there's an opportunity to own the best businesses at a reasonable value, we should do that. A year ago, if I came on your show, I would have had probably 25% of my portfolio in names like Microsoft, Google, Amazon, Uber, Salesforce. Today, I probably have 12.5% of my portfolio in those names. We're always, as sort of value-driven investors, probably going to sell a little bit early. But I think it's a very hard thing for an investor to have a whole portfolio with no bets on these amazing large companies that are allocating capital in such attractive ways, spending on R&D and leveraging technology.
Are you surprised at all that the S&P is at these lofty levels, record highs, just given what the backdrop has been, or does it just make sense to you?
Well, I think the surprising thing is if we started the year, people thought the Fed was going to cut interest rates 6 or 7 times. Now consensus thinks they're going to do it 1 or 2 times. So if you had said to people that that was going to be what would have happened, everyone would have thought that equities would have faced a real headwind. The offset's been that fiscal policy has been so substantial that despite the Fed's desires to try and be restrictive with monetary policy, we have a really good, healthy economy. We're at full employment. The consumer is still relatively strong. So you combine that with a huge product cycle. There's lots of elements of today that feel a little bit like the boom of the late 90s, early 2000s. And if you told me that these 5 or 10 companies were going to act the way they would, it would be completely reasonable that the index is where it is. So said differently, if I look at the average company in the S&P 500, my sense is they trade at an appropriate valuation. It's not a streaming buy or a screaming sell.
Does the overall valuation, if you take it as a whole, does it make sense to you just relative to where rates are, where the economy is? I've had some question where we are now, and they make the comparison to 99, say this is the most expensive market since then. We all know how that ended. Yeah. Is that a fair comparison or no?
I don't think it's a fair comparison. And what I would say is the bubblicious names aren't what's driving the market. Unprofitable tech is not soaring. So if you look and say, if you back out these AI winners and look at the average business, they trade at relatively reasonable valuations. There's winners and losers. My guess is it's a stock picker's market. It's trying to find the right story. But we look at our portfolio, there's lots of good businesses that trade at reasonable valuations. Mm-hmm. Inflation expectations have been anchored. I think the Fed's done a really good job. The 10-year sits at 4.25. So the concept of buying the average good business at 14 or 15 times earnings who can leverage R&D, AI, cheap access to capital, despite the Fed raising rates. The private credit markets have been alive and robust. The Fed's balance sheet has expanded from $800 billion to almost $9 trillion. So there's a massive amount of liquidity in the system. We're running a 6% deficit with full employment. So during that environment, it doesn't sort of surprise me that it's a decent time to run or buy a